There's a quiet weight at the beginning of this part. Morgan Housel doesn't start with rules or formulas. He starts with people. With behavior. With the way we respond when uncertainty shows up in our lives. It's easy to think we are rational, that our decisions are guided by logic. But the truth is softer, more complicated. We are shaped by fear, by hope, by small memories from our past that we barely notice. In the first two parts, we saw how our history guides our choices. We saw how luck and risk tangle together. We saw that being reasonable often matters more than being perfectly rational. And yet, even after all that, Part 3 asks something different. It asks us to notice how fragile plans can be. How the person making a decision today might not be the one living with it tomorrow. Our priorities shift over time. What once felt safe might feel unbearable later. What once seemed impossible might feel necessary. Housel invites us to watch these shifts quietly. Not to judge ourselves, and not to judge others. But to see how subtle, almost invisible forces shape our choices. This part of the book isn't about mastery. It isn't about predicting the future. It's about coexisting with uncertainty, about building decisions that last even when the world refuses to stay still. We notice how fear nudges us toward comfort. How hope pushes us toward risk. How pride and memory quietly steer our choices without permission. And slowly, we come to a realization. The best decisions aren't always the smartest. They are the ones we can live with, the ones that survive the unpredictability of life. That's the quiet challenge of this part. To accept that control is limited, but endurance is possible. To notice the choices that matter, even when they seem small. Once we hold that in mind, the first chapter of this part becomes almost unavoidable. It asks, why being reasonable often beats being rational. And why survival, patience, and flexibility quietly matter more than brilliance on a spreadsheet. Let's begin with some reasonability. Chapter 11, Reasonable is greater than rational. There is a subtle idea running beneath almost every financial decision we admire. We tend to assume that the best outcomes come from the smartest thinking. That success is a reward for being rational, disciplined, and mathematically correct. That if someone did well with money, they must have made the optimal choices. But when you sit with this assumption for long enough, it starts to feel incomplete. Because real life rarely rewards what looks perfect on paper. Morgan Housel introduces this chapter by questioning something most of us take for granted. That rational decisions are the same as good decisions. They aren't. Rational decisions aim for the best possible outcome. Reasonable decisions aim for outcomes that people can actually live with. At first, this difference feels small. Almost semantic. But the more you think about it, the more it explains why so many intelligent people struggle with money. And why many ordinary people quietly do just fine. A rational plan might make sense in a spreadsheet. It might maximize returns over decades. It might assume discipline during downturns and patience during boredom. But it also assumes something else. That the person following the plan never changes. That fear doesn't creep in. That doubt doesn't linger. That exhaustion doesn't accumulate. And that assumption rarely holds. People don't abandon financial plans because they suddenly become irrational. They abandon them because the plan becomes emotionally unlivable. Housel makes a quiet but powerful observation here. Most financial failures don't happen because people didn't know what to do. They happen because they couldn't keep doing it. The math didn't break. The behavior did. Markets fall and stay down longer than expected. Confidence erodes slowly, then all at once. What once felt manageable begins to feel overwhelming. In those moments, the most rational strategy in the world offers very little comfort. This is where being reasonable matters. Reasonable decisions leave room for reality. They accept that fear will show up uninvited. They acknowledge that discipline has limits. They assume that we will not always act with clarity or calm. Instead of fighting human nature, they work around it. Housel isn't arguing against intelligence. He's arguing against fragility. A fragile strategy only works if everything goes right. A durable one survives even when things go wrong. This is why so many successful investors look unimpressive on the surface. They don't chase maximum returns. They don't rely on precision timing. They don't assume perfect behavior from themselves. They choose paths that feel sustainable. Paths they can stick with when headlines are loud and outcomes are uncertain. And that ability to stay put often matters more than brilliance. There's also something deeply personal about this chapter. What feels reasonable to one person might feel unbearable to another. Two people can understand the same risks, read the same data, and still make completely different choices. Not because one is smarter, but because their lives are different. Different responsibilities. Different memories. Different thresholds for stress. A strategy that allows one person to sleep peacefully might keep someone else awake every night. This is why copying someone else's financial plan is more dangerous than it appears. You're not just copying numbers. You're copying emotional assumptions that may not belong to you. Housel gently reminds us that money decisions are not made in isolation. They are made alongside family, health, career uncertainty, and personal history. Ignoring that context doesn't make a plan smarter. It makes it fragile. There's a humility embedded in this idea. It accepts that humans are imperfect. That discipline fluctuates. That confidence fades. But instead of seeing these traits as flaws, Housel treats them as constraints worth respecting. The goal isn't to build the perfect strategy. It's to build one that survives you. One you can follow not just when things are going well, but when they're confusing, discouraging, and uncomfortable. Because time is the real advantage in money. And time only works if you stay in the game. Being reasonable helps you do that. It keeps you invested. It keeps you patient. It keeps you from abandoning long-term plans during short-term pain. Slowly, this chapter shifts how you define success. Success stops being about optimization. It becomes about endurance. About avoiding decisions that feel unbearable, even if they look impressive on paper. And once you see money through that lens, another realization begins to form. If survival matters more than perfection, then risk isn't something to eliminate entirely. It's something to understand deeply, to choose carefully, and to respect. That's where the book leads next. Toward risk, ruin, and the thin line between ambition and destruction. Chapter 12, Surprise. There's something deeply uncomfortable about admitting how little control we actually have. We like to believe that outcomes are earned. That success follows effort. That failure is a sign of poor judgment. But as you sit with the stories of money long enough, another truth starts to surface. One that doesn't fit neatly into merit or intelligence. Much of what happens to us is shaped by surprise. Morgan Housel doesn't introduce this idea dramatically. He doesn't frame it as injustice or unfairness. He simply observes how often unexpected events change the direction of entire lives. And once you notice it, you start seeing it everywhere. People build careful plans. They think in decades. They run the numbers again and again. And then something happens that wasn't on the spreadsheet. A crisis. A breakthrough. A mistake. An opportunity that arrives too early, or too late. Surprise has a way of ignoring preparation. What makes this unsettling is not that surprises exist. It's that we consistently underestimate how powerful they are. Housel reminds us that history is dominated by events that no one predicted. The most influential moments in markets, careers, and economies were often invisible just before they occurred. When we look backward, those moments feel obvious. Inevitable. Almost logical. But that clarity is an illusion created by hindsight. In real time, surprise feels confusing. Disruptive. Often frightening. This is why people struggle with long-term planning. Not because they can't think ahead, but because the future refuses to stay familiar. We plan using what we already know. But life tends to be shaped by what we don't. Housel points out something subtle here. Surprise doesn't just change outcomes. It changes behavior. When unexpected success arrives, confidence grows quickly. Sometimes too quickly. People begin to assume skill where chance played a role. And when unexpected failure strikes, doubt creeps in just as fast. People question decisions that were reasonable at the time. They blame themselves for not seeing what couldn't be seen. Both reactions are understandable. Both are incomplete. Surprise blurs the line between luck and skill. It makes success feel earned and failure feel personal. Even when neither interpretation is fully true. This is why judging financial decisions purely by outcomes is so misleading. Good decisions can lead to bad results. Bad decisions can sometimes work out beautifully. The presence of surprise breaks the neat link between choice and consequence. Housel doesn't ask us to stop planning. He asks us to plan with humility. To acknowledge that the future will contain events we haven't imagined. That no amount of intelligence can eliminate uncertainty. That resilience matters more than precision. This idea quietly shifts how you view risk. Risk is no longer just about volatility or downside. It's about exposure to surprise. About how vulnerable you are when something unexpected occurs. And since surprise is unavoidable, the question becomes less about predicting it, and more about surviving it. People who endure tend to leave room for the unknown. They don't optimize every variable. They don't stretch themselves so thin that a single shock ruins everything. They accept that the world will change in ways they didn't anticipate. There's a calm realism in this chapter. It doesn't promise control. It doesn't offer certainty. Instead, it offers perspective. It reminds us that the most dangerous assumption in finance is believing that tomorrow will look like yesterday. Once you accept the role of surprise, your relationship with money changes. You become less obsessed with forecasting and more focused on flexibility. Less concerned with being right, and more concerned with being able to continue. And that naturally leads to another uncomfortable idea. If surprise shapes outcomes, if luck and uncertainty play a larger role than we'd like to admit, then what does that mean for confidence? For ego? For the stories we tell ourselves about why we succeeded, or failed? That question sits quietly at the center of the next chapter. And it challenges how we think about certainty, belief, and the illusion of control. That's where we go next. Chapter 13, Room for Error. There's a quiet assumption behind many plans we admire. That they will work as expected. That things will more or less go according to script. That deviations, if they happen, will be small and manageable. But life rarely cooperates with that kind of confidence. Morgan Housel introduces this chapter by focusing on something most people overlook: the distance between what can go wrong and what we prepare for. Not the obvious risks. The subtle ones. The ones that don't announce themselves in advance. Most people don't fail because they aimed too low. They fail because they left no room for mistakes. They planned for the average outcome. They assumed stability. They expected consistency from a world that rarely offers it. Housel reminds us that history is shaped by extremes, not averages. By moments when things went far worse, or far better, than anyone expected. And when plans are built too tightly, those extremes don't bend them. They break them. There's something psychologically comforting about precision. About feeling fully invested. About believing that confidence comes from commitment. But total commitment leaves no margin for error. A small setback becomes catastrophic. A temporary downturn feels permanent. A surprise turns into a crisis. This is why endurance often has little to do with intelligence. It has more to do with flexibility. People who last tend to leave space. Space for mistakes. Space for bad timing. Space for the simple fact that they might be wrong. Housel gives examples of individuals and systems that survived not because they were perfectly planned, but because they were forgiving. They could absorb shocks. They could recover. They didn't demand perfection from every decision. That forgiveness matters more than it first appears. When you leave room for error, you gain psychological stability. You don't panic at the first sign of trouble. You don't feel forced to react immediately. You can pause. You can think. You can stay put. And staying put, quietly, is one of the most powerful advantages in finance. Without room for error, every decision feels fragile. Every outcome feels final. Every surprise feels like a verdict. Housel isn't suggesting caution for its own sake. He's pointing out that survival requires slack. Too much optimization creates brittleness. Too much leverage removes options. Too much confidence eliminates recovery. Room for error does the opposite. It creates resilience. It gives time a chance to work. It turns bad luck into inconvenience instead of ruin. There's also a personal side to this idea. Many people push themselves into financial strategies that leave no emotional margin. Plans that only work if confidence never wavers. If income never dips. If life never interrupts. And when reality intrudes, as it always does, those plans collapse under their own rigidity. Housel gently suggests a different approach. One that values staying power over precision. One that accepts slower growth in exchange for durability. Because the goal isn't to avoid mistakes. It's to make mistakes that don't end the game. Once you see money this way, priorities begin to shift. You stop asking how much you can gain. You start asking how much you can afford to lose, and still continue. That question changes behavior. It tempers ambition. It strengthens patience. And it quietly prepares you for the next idea in the book. Because if room for error is essential, if survival depends on flexibility, then the biggest risk might not be market volatility at all. It might be the desire for certainty. The need to feel in control. The urge to believe that the future will behave. That's where the next chapter takes us. Toward confidence, belief, and the stories we tell ourselves when reality refuses to cooperate. Chapter 14, You'll Change. There is one assumption that quietly sits behind almost every financial plan we make. We assume that the person we are today will be the same person 10, 20, or 30 years from now. We assume our goals will stay the same. Our risk tolerance will stay the same. Our ambitions, fears, desires, and definition of enough will stay the same. But that assumption is almost always wrong. The most important force shaping your financial life is not inflation, interest rates, or the stock market. It's you. And the uncomfortable truth is this: you are going to change. Not slightly. Not gradually. But fundamentally. The problem is not that change happens. The problem is that we don't plan for it. Psychologists have a term for this: end of history illusion. It's the tendency to believe that who you are today is who you'll be forever. When researchers ask people how much they've changed over the past 10 years, they say, a lot. But when asked how much they expect to change in the next 10 years, they say, not much. We look back and see growth. We look forward and assume stability. That blind spot quietly leaks into our financial decisions. At 25, you think you'll always love working 70-hour weeks. At 35, you think money will always matter more than time. At 45, you think success will always look like growth and expansion. And so you build a financial life optimized for a version of yourself that doesn't exist anymore by the time you get there. This is why so many people reach financial milestones and feel empty. They didn't fail financially. They succeeded for the wrong version of themselves. Think about how much your values have already shifted. What excited you 5 years ago may now feel meaningless. What once felt boring may now feel priceless. Your appetite for risk, stress, status, and sacrifice has likely softened, not because you became weaker, but because you became clearer. Money magnifies this effect. Because money locks in decisions. A 30-year mortgage assumes you'll want the same lifestyle for 3 decades. A career chosen for prestige assumes you'll value recognition forever. An aggressive savings plan assumes your future self will thank you for the stress you tolerate today. Sometimes they do, often they don't. This doesn't mean long-term planning is useless. It means rigid planning is dangerous. The most resilient financial plans are not precise. They are flexible. They don't try to predict the future. They prepare for a range of futures. They leave room for regret, boredom, burnout, curiosity, and reinvention. Because real life is not a straight line. People change careers. They fall in and out of love with cities, industries, lifestyles, and ambitions. They experience loss, illness, children, awakenings, and priorities they never imagined. A financial plan that only works if everything goes right is not a good plan. A good plan works even when you change your mind. This is why the idea of enough is so powerful. Enough is not a number. It's a boundary. It says, I don't need to keep pushing just because I once decided to. Enough gives you permission to adapt. Without it, every change feels like failure. With it, change feels like growth. Many financial disasters are not caused by ignorance or bad math. They're caused by stubbornness. People cling to old goals because admitting change feels like admitting weakness. But change is not inconsistency. It's learning. The most dangerous financial belief is, I'll figure out what I want later. Because later arrives with consequences attached. Instead, the smarter question is, what kind of life gives me the most room to change? Room to slow down. Room to speed up. Room to pivot. Room to walk away. that room is often more valuable than maximizing returns. This is why low fixed costs matter. Why liquidity matters. Why avoiding irreversible decisions matters. Freedom is not about having more options tomorrow. It's about not being trapped by decisions made yesterday. The irony is that the more aggressively you optimize for a single future, the less prepared you are when that future doesn't arrive. And it usually doesn't. So the goal is not to guess who you'll be. The goal is to build a life that doesn't punish you for becoming someone else. Because you will. You'll care less about impressing people. You'll care more about peace. You'll trade excitement for stability, and later trade stability for meaning. You'll redefine success more than once. And when that happens, money should be a tool that adapts with you, not a cage that locks you in. The people who appear most confident in their financial lives are often not the ones with perfect foresight. They are the ones who gave themselves permission to evolve. They planned, but they didn't overcommit. They saved, but they didn't suffocate. They aimed high, but they kept exits open. They understood something simple and rare. Your greatest financial asset is not intelligence, discipline, or even patience. It's humility, the ability to accept that the future version of you deserves a vote. And that vote may change everything. Chapter 15, Nothing is Free. One of the most uncomfortable truths about money is also one of the simplest. Everything has a price. Not just in dollars. But in stress, uncertainty, regret, time, and in the emotional cost of sticking with a decision when it stops feeling good. We like to believe that good financial choices are clean. That smart investing means finding opportunities with upside and no downside. That if we just learn enough, read enough, and analyze enough, we can avoid pain entirely. Morgan Housel dismantles that idea in this chapter. He reminds us that there is no such thing as a free lunch in finance. Every strategy comes with a cost. And the real challenge isn't avoiding the cost. It's deciding which cost you're willing to pay. Most people don't fail with money because they choose bad strategies. They fail because they choose strategies whose hidden costs they can't emotionally tolerate. Take investing in stocks. Over long periods, stocks have delivered extraordinary returns. This fact is widely known. It's written in books, charts, and historical data. And yet, many people still fail to benefit from it. Why? Because the price of stock market returns isn't volatility in theory. It's volatility in real life. It's watching your portfolio drop 30% and wondering if this time is different. It's opening an app during a market crash and feeling your stomach tighten. It's lying awake at night questioning whether patience is wisdom or denial. That discomfort is the fee. And it's a fee most people underestimate. Housel's point is subtle but powerful. Returns don't come from optimism, they come from endurance. The ability to sit through discomfort. The ability to stay invested when logic says, hold, but emotion screams, escape. If you can't pay that emotional price, the long-term returns don't matter. They were never available to you in the first place. The same logic applies everywhere else. High leverage can amplify gains. But the price is fragility. One wrong move, one unexpected event, and everything collapses. Concentration can accelerate wealth. But the price is sleepless nights and the constant fear of being wrong. Cash provides safety. But the price is watching opportunities pass you by and inflation quietly erode your purchasing power. There is no universally best choice. There is only the choice whose price you understand and accept. Most financial mistakes happen when people focus only on the reward and ignore the fee. They chase returns without respecting volatility. They admire successful investors without seeing the stress, doubt, and drawdowns that came with the outcome. They copy strategies without copying the temperament required to survive them. This is why financial advice often sounds good in theory but fails in practice. Because it describes the destination, but not the tolls along the road. Housel argues that the most important question isn't which strategy makes the most money. It's which strategy can I stick with during the inevitable periods of pain? That question forces honesty. It forces you to admit your limits, your tolerance for uncertainty, your reaction to loss, your emotional breaking points. And that honesty is far more valuable than intelligence. Many people would be better off earning slightly lower returns with a strategy they can maintain for decades than chasing higher returns with a plan they abandon at the worst possible moment. Because the biggest cost in finance is not volatility. It's panic. The irony is that the price of successful investing is often paid in advance, long before the reward arrives. You pay it through boredom during long stretches of underperformance, through doubt when others seem to be getting richer faster, through patience when nothing appears to be happening. And most people don't quit because the strategy stopped working. They quit because the waiting became unbearable. This is why Housel emphasizes behavior over brilliance. You don't need the optimal strategy. You need a survivable one. One whose costs you've consciously accepted. One that lets you sleep at night. One that doesn't require you to be a different person under stress. Nothing is free. Every financial decision extracts a price. Either now or later. Either visibly or quietly. Either emotionally or mathematically. The people who do well with money aren't the ones who avoid costs. They're the ones who choose their costs deliberately. They understand that discomfort isn't a signal to quit. It's often the entry fee. And once you accept that, once you stop searching for pain-free strategies, you stop being surprised by the inevitable ups and downs. You stop mistaking volatility for failure. You stop expecting smooth paths in a world built on uncertainty. You begin to play a longer, calmer game. And that shift, more than any tactic or formula, is what separates people who endure from those who constantly start over. In the next chapter, Housel pushes this idea even further. He explores how our relationship with money changes when we stop trying to impress others and start defining what enough actually means. Because once you understand the cost of everything, the most powerful skill left is knowing when you already have enough. As we close this part of the book, a quiet pattern starts to emerge. None of these chapters were really about tactics. They weren't about beating the market, finding the perfect investment, or optimizing every decision. They were about something far less glamorous, and far more important. They were about how people behave when money puts them under pressure. We saw how success is often confused with skill. How luck and risk shape outcomes in ways we rarely acknowledge. How room for error matters more than brilliance. And how every financial decision comes with a cost, whether we notice it or not. If there's one underlying message running through this entire part, it's this. Money is less about what you know, and more about what you can live with. The strategies that look smartest on paper often fail in real life. Not because they're wrong, but because they demand emotional strength people didn't realize they'd need. And that's uncomfortable to accept. Because it means better results don't come from more information alone. They come from self-awareness. From knowing your limits. From choosing plans you can stick with when things stop feeling easy. This is the point in the book where the focus begins to shift. So far, we've been looking at behavior under uncertainty. How people react to risk, luck, fear, and volatility. Next, Housel starts asking deeper questions. Questions about ambition. About comparison. About why doing well often still doesn't feel like enough. In the next part, we'll explore ideas like how chasing more can quietly cost us freedom, why wealth is often invisible, and how the hardest financial skill isn't earning money. It's knowing when to stop. Because once you understand behavior, and once you understand cost, the next challenge becomes far more personal. What are you actually trying to get from money? That's where the conversation gets even more uncomfortable. And much more honest. We'll continue there in the next part.